Hello.
Hey, Mike, how are you?
I'm doing well. And yourself?
Well, back to the grind.
Yeah, did you have a good long weekend?
Yeah, it was good. We had nice weather, family. My middle daughter made her confirmation, so we had a bunch of family in town for that. So it was just kind of, you know, just ate too much, drank too much. Good Memorial Day weekend.
Yeah, there you go. You did not light yourself on fire over a charcoal grill, so that's always a
Yeah,
success.
yeah, all good there. All good there. How about you? All good?
Yeah, a friend of mine has a lake house, and we went and helped him get everything up and running at the lake. So,
Wisconsin or where at?
yep, in Wisconsin, pretty
Yeah.
close to Lake Geneva. I found myself standing underneath a boat lift in the muck. That was a bunch of fun. But
Somebody's got to do it, right?
exactly. Once it's done, then everybody has fun. Um, all right, so let's kick this guy off. We're here, end of May. Can you believe it? We are
No,
five
no,
months.
I cannot believe it.
And oh, you know what? I do want to hang on. I got a prop for today. Hang on just a second. All right, I'm back. I'm back. Uh, check this out. You probably saw this, but lumber made the Wall Street Journal. And what's really kind of cool is what I got?
Yeah, I think I know the guy that they quoted there.
There you go. Ashley Buckholt and Materials Exchange got quoted.
Awesome. That's pretty cool.
Um, but I think what's really interesting is how lumber has become. I think we all knew it was a bit of a bellwether for the overall economy, but people are really looking at it now.
Yeah, obviously we were in Montreal last week and met with the CME, Chicago Mercantile Exchange, and then, we had the main meeting, and then we had some side meetings. And Allison was telling me that the CME puts out their weekly, daily publications, and lumber, when they did a write up on lumber, it's still their number one read article on the CME's website this year, like
Really?
by a moonshot. Yeah, yeah. So it is the her phrasing, not mine. It's still the sexy commodity that everybody wants to talk at, look at. So our 15 minutes of fame continues on here.
Well, and you know, a feather in our cap and your cap is we have tapped into this ferocious appetite for information by doing this show and some of the other shows. And it's a good thing. These are all really good things for the industry because the more people know, the better decisions they can make.
Yeah, absolutely, without a doubt. And I'm making up for last week's condensed version. There's just a lot of stuff out in this past week to go over.
All right, let's go. Let's
So
do it.
let's go. I think after last week, the Wood Convention should have passed out T-shirts that said "I survived the convention 2022." I figured out I was not in convention shape. But let me jump in here. Uh, Before we jump into this, my big takeaway from the convention was that rail is not going to improve anytime soon, and there's no real appreciable build in inventory in the secondaries at distribution at the end user level. Whatever build of inventory still remains at the sawmill level. I think the consensus with housing is that single family obviously has some significant hurdles ahead of it. There's still a massive backlog of business, this was a completely different convention versus the last one in 2019. In that, let's not kid ourselves. You probably had significantly more multimillionaires walking around the convention floor over the last 2-3 years, and being the beneficiaries of trading lumber.
Yep, I'm sorry, I messed up here. There we go. All right, go ahead. Yes. I think it's not just the multimillionaires or the millionaire trading lumber, but everyone in the forest products industry, even down to the home builder.
Absolutely, absolutely. So we'll start big and funnel down to our lumber market. I think, here's a kind of a weekly overview of equities, crude oil, lumber, and interest rates. And the two things that jump out here is that crude oil continues to appreciate. You had the actual embargo announced by Europe on Russian crude. So crude oil, front month crude's got up to $120 today. Interest rates have started to moderate. We were at 2.85% on the 10-year. A week ago, we were somewhere in that 2.93 area after peaking out at 3.13. You've gotten a bounce off the lows in equities. Lumber seems to be kind of going sideways, going nowhere fast.
I feel like crude is a little bit of what lumber was 12 months ago.
Yeah, and I was that's the segue into here's a daily WTI Western Texas Intermediate crude oil chart. This is the predominant crude that's traded in the United States in futures, and you can see onset of the Ukrainian conflict with Russia. We're still in that uptrending scenario where front month crude is again just under a hair under $120. D's 22 as of this morning traded up to 105. D's 23 traded up to 89. So crude definitely has that inverted supply constraint bull market structure. If I flip to the next one here, here's RBOB. This is unleaded gas, kind of all-time high. We continue to trend higher here. So futures are 415. You obviously know what you're paying geographically at your own pump. The amazing thing, this is a 1 month return, and I'm not sure, I don't want to be too critical, overly critical, but I'm not sure what the Fed or the administration or anybody else from an economic standpoint is looking at to say that inflation is moderating. You look at the leaders of the pack here: RBOB, nat gas, crude oil, Brent crude, heating oil, wheat, butter, oats, all core food and energy type items. Crude oil is up. Unleaded gas in the last month is up 18%. You feel that at the pump. Crude oil is up 14%. This is in the last month. Flip forward to 52 weeks. Nat gas, heating oil, RBOB, crude oil, Brent crude, wheat, canola, oats. Again, these are all your energy and food staple type items. I mean, look at the change in natural gas year over year, up 221%. Heating oil up 106%. RBOB up 97%. Crude up 93%. So I'm just dumbfounded when I hear that inflation's moderating. I'm not sure if anybody that kind of makes this analysis actually fills up their own car or shops at the grocery store for themselves.
But the purpose, okay, the way the system works is that when prices go up, you have demand destruction, and you don't get demand destruction until the prices are high and makes the population change their behaviors. So you could sit here and say, oh, there's going to be an invasion of a country and there's going to be a bunch of embargoes, and crude has the potential to go to this high number. Please, everyone, start to moderate your travel. No one will do it until it actually pinches them.
Yeah, no, absolutely. I think that's a great point.
The only forward thinkers in that whole energy scenario are actually the airlines.
Yeah.
So the airlines are actually cutting flights because they know that the price to travel is going to be so expensive due to the cost of jet fuel that it's going to create some demand destruction.
And ultimately, that's the cure for higher prices. Ultimately, is the cure for higher prices is higher prices. The John Maynard Keynesian approach to economics, and that eventually you price out the demand component. So here's CPI. I think we went over this one last week, but here's another updated version. Obviously, inflation just isn't a U.S. problem; it's a global problem. It's a Europe problem. It's a Japan problem. And you still see signs. Even lowly Japan that suffered through deflation for the last 30 to 40 years, they actually have positive inflation, which is just amazing. I mean, it's you know that there's real inflation when Japan actually has positive inflation. I'm going to
You know,
run through these if you want to stop it all, Mike.
I just one comment I have that I've read recently about the production of oil in the Soviet Union, and they are still shipping records amount of oil out of Russia.
Yep.
It's going to India and it's going to China.
Yeah. Yep.
So what's going to be kind of interesting to look at is those are also two of the countries that produce so much stuff that we consume. I think if China can figure out its COVID situation, they could turn out to be the low cost producer again.
Yeah, no, absolutely. Absolutely. India and China are more than happy to take that embargoed oil and have no qualms politically in doing it. They're going to be the beneficiaries of Chinese dumping of oil. The other thing that I heard in Montreal from a Euro producer, a very large one, was that Russia is still exporting logs and dimensional lumber into Europe, and the deadline to do that is July 10th. So they are flooding the European market right now with Russian logs, Russian finished goods inventory and lumber, and have until July 10th to continue to do this. So the idea you're going to see less wood coming here from Europe. The reality is, from a timeline standpoint, it's probably the end of July through the middle of August where you actually see European wood. Once they exhaust that Russian supply that's coming in, you're probably talking the end of July into the middle of August before you see any significant shift of Euro wood staying in Europe and not coming here. That blew me away that Russia was still shipping into Europe with logs.
Right. It's I think everyone sees the big headlines of, oh, we're not getting any more Russian fiber, or we're boycotting Russian fiber. The reality is it's still getting in somewhere, somehow.
Yeah. So I thought this was interesting. Like, you mentioned, referenced crude oil, equities. These are the new volatile commodities where they've kind of taken the torch passed from lumber, where the S&P year to date is having its most volatile year. You have to go back to 2007, 2008. You have to go back to the dot-com crash in 2000. 2001, 2002, but volatility reigns supreme, just not in lumber right now. But the volatility has spilled over into a lot of these other areas, from equities to the other physical commodities out there. This is no shock, but you can see equities leading the charge down in PMI, Purchasing Manufacturers Index. So it's interesting to see. We are starting to see signs of less durable goods, less production out there, and I think a lot of this, like you referenced, Mike, is probably an anticipation of that, what lies ahead from a demand destruction standpoint, as far as companies getting ahead of it. But you are starting to see this reflected now in U.S. PMI, where you are starting to stair step down, kind of following the S&P to the downside. I thought this was really interesting. This is effect of rising prices on consumers' view of investing in durable housing goods. So you can see, this goes back to 1978. So you're from a just pure kind of risk on, risk off standpoint. The consumer is seeing significant risk in the form of higher prices, to where you're truly back to the early 80s, late 70s, is the last time you really saw inflation impact the consumer, or the potential to impact the consumer here from a durable goods consumption standpoint. We'll run through this. This is consumption, durable goods, non-durable goods. You can see, you're definitely starting to see that uptrend, go sideways and start that downward slope now, where again, you're starting to see signs, whether you're actually seeing that demand destruction at the consumer level, you're definitely seeing it at the corporate level, where let's start to rein it in. Let's not just get, let's not get have this cavalier attitude when it comes to production. Let's start to produce a little bit less in anticipation of what's likely going to come. Um, this was interesting in that, this is proof that the free money, these are, this is just an aggregate overview of global rate hikes versus rate cuts. And, here's your pandemic. Coming out of the pandemic, the reining in of free money, where globally, again, not just in our country, but this is a composition of 55 countries. The propensity now is to raise interest rates, not lower interest rates, not maintain. So you're seeing a global rate increase out there, not just in the U.S. This is something we'll go over this. There's just too much to cover, but the idea of what lies ahead here, if you're going to go into a recession, the idea of stagflation, I think we'll cover this in the next couple of weeks with some technical type indicators. But the idea of what stagflation is and the anticipation of what it does to economic growth. But we'll come back to this at another show, because we could spend an entire show just discussing this. So the other big thing, free money is off the table. Again, here's all the free money in the form of the Fed pumping it into the economy. You can see now, from a personal savings standpoint, we're back below pre-pandemic type levels. Higher cost of materials, the free money is out of the equation from a Fed standpoint. And not only that, people are spending more, and it's, you're seeing it firsthand with personal savings. You're trending in the wrong direction here.
You're spending what you saved.
Yeah, exactly. So jumping into housing now, I thought this was a good one. Time spent in residence versus pre-pandemic baseline. So you can see we're back at the low water mark of people are out and about still, which is still good from a money multiplier standpoint. People are out there still spending money, but they're spending significantly less time at their house versus the last 2 years here, which is, obviously. This is a month supply of new homes in the U.S. So we continue to build, and interestingly enough, our housing supply has gone up dramatically over the past 2 years. I mean, look at
And
where we were at
just so
a year ago.
we're clear, that number is calculated by the total inventory divided by the selling rate. So
Yep.
the reason it's jumping, I mean, it could be that there's more new homes coming on, but it jumps like this when the rate of sales starts to drop.
Yeah, no, I think that's a great point. This is definitely a function of rate of sales. And I wish I didn't pull this up, but existing homes, that's where you're seeing the influx of homes come on. Sorry.
That's where you're.
Oh, you're muffled now. There you go.
There you go. That's,
you're still.
I think that's supply.
Mike, can you hear me?
Now we can hear you.
Okay. Sorry, I bumped my cord. No, I think that's a great point. This is a slowdown in the sale of new homes for obvious reasons. It's the existing homes where you're seeing that influx, that build of new homes coming on the market in the form of existing home sales.
Okay.
30-year rates are definitely, they've started to moderate, just like the 10-year. Historically speaking, still relatively low, but over the last, again, this goes back to, you're back at 2009 type interest rate levels right now.
Okay.
We had Case Shiller out this morning, and I'll let everybody kind of digest this. This breaks it down based upon metropolitan area. And then at the bottom, you get a U.S. national average, but 1 year change, aggregate changes were up about 20, up just south of 21% year over year. and you can kind of see the breakdown geographically of home price appreciation depending on your neck of the woods.
Yeah, on the way in this morning, I was listening to the radio, and they were just talking about housing and how home prices, and what would happen, or what's it going to be like if for the next 10 years there's no appreciation?
Well,
which is not unheard of.
Hopefully you traded up or got into a place that you want to live in, because that's realistically where people that overbought here are buying now. I think you have to have that expectation you're actually going to live there versus getting this continued appreciation to churn and burn and flip it. I think now you're buying with the idea there's a shortage of homes, and you're going to sit on it knowing that you're still at a level where you still have a shortage of homes. So I know we've talked about this, but I thought this was another good graphical representation. So this is percent of mortgage payment based upon median household income, and you're basically cresting today back to kind of pre-housing bubble type levels where we peaked out back in 2005, 2006.
Right,
so,
and the rule of thumb is 20% is what you should shoot for, correct?
Yeah. Yep.
So yeah, we're definitely, housing is expensive on a relative basis.
Absolutely. I'll run through a couple more and then we'll jump into lumber here. So this is another great one. This is from Len Kiefer. Len is on LinkedIn, and Len does exhaustive analysis, and he publishes all of his data where he pulls it and he shows you all of his equations, which is pretty cool from an econometric standpoint. He just doesn't put stuff out. He gives you the basis for his rationale. But you can see from a real house price in the United States, we've blown through, according to his metrics, we've blown through actual cost of home ownership, the 2005, 2006, 7 type levels, where we're at all-time highs here to own a home. Real house price, this is broken up into, obviously, you've got areas like California and Texas leading the charge. You've got laggards like Ohio, Virginia, and I picked Ohio just because that's obviously where I live. But you can see, you've had appreciation, but nothing near like you've had in California, Texas, Virginia, and some of these other states where, again, my question is always, does income growth justify price home appreciation, the cost of living in some of these metropolitan areas? And I'm always amazed that does somebody truly make that much more money living in some of these other states to justify the cost of living?
Right. It baffles the mind sometimes.
And here's another scatter graph of, again, these are your high cost areas versus the low cost states. And amazingly, your state surprisingly was down here. And then you get into the obvious Texas, Colorado. These are really your hot areas. Arizona, I thought would be higher. California, they're still high, but not relatively as high as like a Colorado or Texas right now. Let's jump into lumber. So lumber is going nowhere fast. I mean, here's your weekly continuation. And again, this is just a small, we just had one day, but it's an inside week here so far. The overall big trend line supports a flush down into the 625 to 580, 570 area. We'll see if we can make it. Here's a July daily chart, again, stuck in the middle of nowhere. You could make the case of trading down into the Bollinger Band low, which is a 603. You could make the case now that you're trying to, or you were at least on Friday back above the 9-day. Can you drift back up into the Bollinger Band moving average, the 44-day, I'm sorry, the 20-day. But the reality is lumber is stuck in the mud going nowhere. where you've kind of starting to suck the volatility out of our lumber market.
Well, the one thing I look at that, and if you flip the chart upside down, you'd be like, hey, the trend is your friend. Go, 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 right?
Yeah, absolutely.
The trend is your
Absolutely.
friend here. And the trend is lower prices. The challenge with lower prices is that there's an end game. Like, you can't go below zero. That we know. Well, except for oil at one time. But we're going to stop in front of zero at some point. We're going to stop when the mills lose less money than they would lose with running, which, I'm guessing that's probably around $300 a thousand.
Well, and so the perfect case in point was Canfor announcing late last week, additional curtailments specifically in BC, where they're going to have rolling shutdowns because look, we're building inventory, can't stack it. So again, we know curtailments will happen, and they could happen at these price levels with the bigs, and it's likely to continue to happen in British Columbia because those are your highest cost of production type sawmills, and they will continue to do this so long as they have rail disruptions, transportation issues. You're going to see that production come out of BC.
Absolutely. And the fact is they've been running these mills hard. So this is a great opportunity. They're flush with some cash. They can do some capital improvements. So, I think you're going to see more of these extended shutdowns over the summer here, especially if, gosh forbid that we have a forest fire issues. But they're going to take a look and say, look, let's do some major maintenance. Now's the best time.
I think CapEx, especially outside of BC, but even in BC, to make whatever exists or is going to exist at the end of the push toward First Nation to make them more efficient. But the other thing I think is critical, you've conditioned your shareholders now to expect a certain rate of return, a certain return on investment, and shareholders no longer have this issue that we need to continuously run where less is more. It's okay to take shutdowns so long as you can give us the quarterly returns, shareholder appreciation on your share price. The average investor now in the forestry sector is more than happy to see less if it's going to result in higher returns to the investor.
Absolutely. Yep.
September, and the one thing I want to point out is, this July SEP spread, and we'll jump into that, but you've had this collapse, and seasonally we're still in a downtrend here, but I'm going to get into here's our price curve, and what's the big difference if we go back to 2 weeks. I'll come back to this, but 2 weeks ago we were in that inverted structure. We were still stair stepping down along the price curve. Well, what's happened in the last 2 weeks? You've had convergence to where now you have July leading the charge to the downside, to where this July SEP spread actually traded 4 under last week. You've had the SEP Nov. Right now, July SEP is 340 over. SEP Nov is 960 under. So you've got this carry structure back along the price curve in futures. You've got the carry structure with lumber spreads. So it's pretty interesting now. You've gone from that inverted structure back to the carry structure. So, you certainly could make the case based upon historicals that we're no longer in this bull market structure in lumber, or lumber futures, lumber cash. We've kind of gone back, and like Kyle just said, we've gone into this contango carry structure, which is more indicative of your bear market type structure. And if we jump into, here's your July SEP. Again, this spread was at $100 over. You were at, kind of peaked back in April in the 60 over area. So you've gone negative on this spread. Same thing with SEP Nov. You've gone negative on the SEP Nov spread. So again, indicative of a carry or bear market structure.
Well, and the spreads, the front month, it runs a big premium when people are building inventory. How do you build an inventory? You buy today for use tomorrow. That just plays itself into having the front month be at such a premium to the back months.
Yeah,
What the
no,
thread is
absolutely.
telling you right now is the fear of the market running away from someone is gone.
Yeah. Yep. And I think, that kind of segues into cash, and some of the numbers we're hearing out there in Doug Fir and an SPF where the premium has gotten evaporated out of the physical cash market. That immediacy, that prompt need is a lot less than it was 2 weeks ago, 4 weeks ago, 6 weeks ago. And that's kind of, going back to the structure we're in, that's why we're in this structure now, where that immediacy, that demand now, people are, from a forward standpoint, we're seeing there's a lot more comfort to buy the back half of this curve in anticipation of future jobs than needing to accumulate right now, because the reality is people can do a lot less. More is less, and that you can do a lot more with less right now. You can really stretch in a falling market structure.
Yeah. So I had a conversation just before the show here with a large regional chain yard, and the buyer there said they're, number one, they're keeping their inventory at 60 days, maybe a little more. And he doesn't have to buy because his contract cars just keep showing up just in time.
Yeah.
Which is a totally different narrative than we were talking a month, 2, 3 months ago, where, I've got all these rail issues. I need to fill in. And he said it's been a bit of a challenge trying to keep the inventory down when cars keep showing up. So there's an underlying theme here, which is normalization. Things seem to be going back to a normal flow, a more predictable flow from, transportation, from the supply chain, even from their takeaway.
Yeah. Yeah, no, I think it, the proof is in your structure between cash and futures, and we'll kind of jump into, again, here's your basis conversion where we came out of this high basis differential, and now you can see it. A week ago, cash was $190 premium relative to July. Fast forward now, and this is reflective as of unfortunately, this is reflective as of yesterday's or Friday's closing price, $695. Just so people are aware, July traded back down to $650 today. Realistically, SPF is probably sub. We know it's at a minimum 740, probably 700. And Doug Fir, I've heard Doug Fir numbers down in that 650 area as well. So you're kind of still keeping a slight premium in cash, but nowhere near where you were a week, 2 weeks ago. And then here's September. A week ago, 195 cash over September. Today, you're down to 55. Same thing in November, down to 61. So again, when you go back to making everybody nauseous here, but when you go back to this structure, we just can't, 2 weeks ago, we were in this inverted structure. Flip the switch to today, we're in this carry structure now where there's a lot more comfort to own further along the curve. And I'll figure out my immediacy in a falling market structure. Hey, look, everything is coming into my favor, especially from a cash.
Oop. We lost Greg for a second there. One of the.
Sorry,
Hello?
I cut out there. Yeah, can you hear me?
Yeah, we can. The other thing, I know when we're looking at the basis, we're talking spruce to spruce because the contract is a Western SPF contract. But the Southern Yellow Pine market's even less expensive. And it's such an important market because it's the growing basket. It's the growing, taking market share. This weekend, I was out at a festival and I saw a gentleman with a shirt on that was from a truss builder in the local town in East Troy, Wisconsin. And I was chatted with him for a little bit. I said, "Hey, are you guys buying Southern Yellow Pine?" And he said, "Yeah, all the time." That's an unheard of statement 10 years ago because everybody knows that Southern Yellow Pine comes into the north and it it just twists and turns and lights on fire, and it's the most demon awful product in the world until it becomes what you have to use, and now it's very usable. So
Yeah, no, it's I think it's interesting in that people still are searching for lowest cost goods out there, and Southern Yellow Pine, we know that's where the organic production will come on. When you look at, and I wish I had this chart in here, I didn't have a chance to put it in, but when you look at a 4-inch species comparison, you have a much more normalized comparison now, where you've got futures leading the charge to the downside. You've got Southern Yellow Pine, you've got SPF, and then you've got hemp fir, Doug fir, kind of still carrying that premium, which they should. But you have a much more normalized structure now between the different species, which it makes a lot more sense than it did earlier this spring.
So, let's wrap this up a little bit and then transition to that conversation that the CME had. I think my 2 cents on this is normalization. And, should you buy long-term right now? Yeah, sure. If you've got business sold, what is the risk to the upside or downside? It's probably both over the next 6 months. I think we can go either direction, and maybe both in that time frame. Should you hold? I think maybe, yeah. If in the very short term here, I think there's going to be a little bit of excess supply. Short term, I'm more bearish, I would say. But I think the fear is out. Like, people have almost gotten control of their inventories, gotten control of their order file, gotten control of their shipping, for the time being, back to normal.
Yeah. No, I think those are great points. And I just want to quickly point out CFTC numbers.
Oh, yeah, for sure.
You had some from the managed money component. Managed money longs are officially out of lumber.
Oh, wow, look at that.
Yeah. And you look at the short position, you're starting to see the momentum selling now, where, my guess is if July were to retest its recent lows, you would trigger more commodity fund type selling. Obviously, these are your last in, first out type guys, traders. So it'll be interesting to see what the trigger point would be on any type of rally to chase this increase in shorts back to the sidelines. And you can see that commercial shorts are taking profits here.
Let's just go back to that managed money. I don't know that everyone appreciates when we say it's fast money. It's really fast money. Like, they're short today, they're flat tomorrow, they're long on Thursday.
Yeah, so, no, it's pretty amazing when you look at it versus other commodities like precious metals or the energy complex or the ag complex. You continue to see managed money builds in anticipation of higher commodity costs, supply disruption in the grain markets, in the energy markets. I think it's massively interesting that there isn't this, usually we talk about there's this diversification of a commodity fund portfolio where they want exposure in all these different markets. No commodity fund wants to be long lumber right now. So, I don't know how much you read into that, but they're obviously reading the tea leaves when it comes to housing. And they're just, even with this pullback now, the analysis of where cost of production could be, I think it's pretty interesting that, the funds don't see any need to have exposure to lumber relative to, again, this diversification of their portfolios with these other commodities that they trade.
Right. I look at these numbers and I see a powder keg that we're sitting on. I don't see the mills in here short. The industry's not as short. Yeah. We're longer than we are short.
Well, and again, you see it with the producer industry build of longs, where, again, I'd still rather own the cheapest wood out there along the curve, where there's comfort. The lower we go, there's comfort for the industry to own, to accumulate in futures versus in cash. So again, when we talk about, who could get pushed out of this market, it's this segment here where these guys could get stopped out pretty fast. This is the other one where this is tough to analyze. these other reportables, long versus shorts. And I'm all ears if anybody has any kind of thoughts on this, because this is where your longs exist right now. Is this industry related? Again, these are your other reportables, typically less than 20 contracts, 25 contracts. So somebody is long this market here. Oh, sorry. Somebody is long this market, having to margin all the way down. You know.
Yeah, you know what? When I will call a bottom when I see those groups kind of bail out of this.
Yeah, absolutely, absolutely.
When we see that non-reportable, other reportables, even the industry just sort of throw in the towel.
And then I'll just, I'm not going to, car velocity continues to increase
It's
or go
fine.
sideways.
There's nothing wrong with car velocity.
Yeah. Here you go. Here's your rail cars originated out of Canada, US. So I know, the one thing we wanted to discuss is that collectively the industry met with the CME in Montreal last week. We're about 95 to 98% there. The hope is we'll see the new contract in place by September. As soon as we have anything in writing, we'll send it out.
Let's review what we know, what we were told. So what we know is the size of the contract is going to be 27,500 board feet.
Correct.
What they're going to do is take the existing contract and you can turn it into 4 new contracts.
Yeah. So the idea, and the CME did confirm, they're going to have an exchange traded spread where you could take a carload of the existing contract. Ah, shit. Sorry, Mike.
Oh my gosh. Greg just fell out of his desk, fell off his desk. The other thing I think is important, the contract will be priced, delivered to Chicago. It's actually delivered into the Chicago switching district. You there, Greg?
Yeah, I'm back.
Okay.
Sorry.
So the size of the contract, 27,500. The price is a price that is delivered to Chicago in a truckload quantity by rail. That's kind of an important thing. So it's not a truck in Chicago, but it's what a truckload would deliver into Chicago by rail. What else do we know? Everything else is going to stay the same. The shipping schedule will stay the same.
Did you reference species deliverable now?
Oh, correct. So now any SBF any Canadian SBF is deliverable, meaning it could come out of Quebec, Ontario, Saskatchewan, if there was any, or the Maritimes, along with Alberta and British Columbia. Doug fir is also deliverable. What is hemp fir is out as of right now, correct?
No, hemp fir is included. It's a kiln dried hemp fir. As long as it's got a number 2 stamp on it, it can be coastal, it could be inland.
Oh,
hemp
okay,
fir,
great.
Domestic hemp fir is a go as long as it's got a number. It's kiln dried number 2.
ESLP is out. SBFS is out. SBFS was never in, but ESLP was in before.
And that's something that could be added down the road, but I think that there were some structural grading issues where I think, for the amount that would potentially use it, they set that aside. That's something that could be added after they roll out the existing contract.
Now, what's so important to note here, though, is that we are talking about what could be delivered. And the number of actual deliveries we've had in the last 10 years is a handful. Correct, Greg?
Yeah, less than 2%, really less than 1% would actually go through CME delivery. But, again, at the end of the day, they have to think of any and every possible scenario and have it spelled out to the nth degree. But just so everybody's aware, 98 to 90% of all contracts, this is a financial tool. Anything that exchanges hands from a physical cash standpoint is done through an EFP, exchange for physical, where it's pre-negotiated between a buyer and a seller. 99% of the time that seller is a sawmill, where you pre-negotiate the actual cash that you want to transact. And the beauty of an EFP, now, and even when the new contract is rolled out, you can EFP a truck-sized. You can EFP a truck. It doesn't have to be a rail car of lumber. You can pre-negotiate a truck EFP, and it can be any species, any item. It doesn't have to be number 2 and better. You can do MSR, you can do studs, anything and everything can be done under that EFP scenario.
And we're going to go in depth on EFPs once again after the new contract is announced. But I think it's important to note, if for whatever reason somehow you were on the buy side and you took delivery, that wood will be showing up in Chicago. If somehow you had to make delivery, you are delivering wood into the Chicago switching district.
Yeah,
this
and
is what the integrity of
the beauty of the new contract, I want to add, Mike, is that you will be able to tender this, meaning you'll be able to know who the other side is. So if it's something that you physically cannot take, it doesn't make sense, you'll have the ability to liquidate your contract ahead of expiration if you physically can't take the wood. If you physically can't take what's being delivered, you will know who that counterparty is prior to expiration, which is critical to where you're not going to get stuck, going through the delivery process and taking something you physically can't take or use.
But that shouldn't be an issue. All right, look, we've gone longer than we anticipated, but you're right. That there was a lot to cover because we're back to normal. I'll say it. We're back to normal times. And we'll see where we go from here. But coming up in the next few weeks, we're going to go over that EFP process. We'll continue to monitor what the CME says, and we'll start talking about some technical analysis.
Yeah, perfect. I appreciate it.
All right, everyone. Thanks for stopping in, and we'll see you next Tuesday.
Thanks a lot. Take care, Mike.